We have built up that RRSP to defer taxes, and now, well, it's time to pay the piper. How can we pay as little as possible? Fasten your seatbelts, folks. This is going to be a good one. An RRSP Meltdown strategy is basically a tax plan that allows you to strategically withdraw money from your RRSP with the goal of limiting the amount of tax the CRA gets from you. In addition to that, another goal of this strategy is to use up most of your RRSP before you pass, as the taxes on your RRSP can be very big in the case where you do not have a spouse or dependent child to leave it to. In fact, the entire thing becomes taxable at your marginal rate. Yikes. There are different ways you can accomplish this. It can include taking money from your RRSP before you retire, or in some cases, you may want to borrow money to invest in income-generating assets outside of the RRSP. You can then use the interest deduction from the loan to offset your tax you are generating as you pull money out of your RRSP. I am always hesitant to like the idea of borrowing money as you near or enter retirement. Instead of that, we are going to come at this with a more grounded mathematical approach. If we are bringing in the numbers, you can be sure we're going to call on our good old buddy, Mr. Math. Join today's conversation. Let me know in the comments if you have a RRSP meltdown plan. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. Before we jump into the RRSP itself, I do want to quickly look at how taxation works in Canada, as that is key to understanding how the overall meltdown functions. Of course, in Canada, you pay both federal and provincial tax. The federal tax is standard across the country, but there are a lot of differences in provincial taxes. I am going to use a chart for combined taxes that I got from assets.ey.com. Since I am in Ontario, I will use the chart for, well, Ontario. The one thing that should stand out on this chart is that the first tax bracket from 0 to 15,705 pays no tax. The next tier from 15,706 to 18,062 is taxed at 15%. I want to drop an example right away to make sure everyone is on board with how these tiers work. If I make $15,000, easy, I pay no tax. But what if I make $16,000? That puts me in the next tax bracket, so I pay 15%, right? If only one of you said yes, then I'm really glad I took the time to give this example. I do not pay 15% on the whole $16,000. I still pay 0% on the first $15,705, and then I pay 15% on the remaining, so $295 that pushed into that higher tier. I would only pay $44.25 in taxes and not $2,400 if they had taxed the whole thing at 15%. We only get taxed by what is in each tier. So if we made $50,000, we pay 0% on the first $15,705, 15% on $2,357, 25.1% on $5,664, and finally 20.05% on the remaining $26,274. In case you are wondering, that adds up to $7,043.15. Keep in mind that this is in Ontario. Some provinces have it worse, like Nova Scotia, where you can only make up to $11,894 before the taxes hit you. Come on, Premier Houston, you can do much better than that. The meltdown process begins before you hit retirement, as you need to be always thinking about the math and how it is aligning towards, well, retirement. In this process, we are going to be thinking about a few things: your RRSP, your TFSA, your current and future earnings, your future OAS, GIS, and CPP, as well as any other pensions you may be entitled to. Retirement is perhaps a way off, and you are kind of thinking about it, but you have time. We all think we have time, but time does have a habit of moving faster than we like. And the best time to be planning retirement is yesterday. The second best time is today. So, depending on your income and your investing habits, you may have investments in your TFSA and your RRSP, or both. Ideally, if both are to capacity, you've done well. But more times than not, that is not the case. Your TFSA should have been a higher priority than your RRSP, as it is, well, it's tax-free. And that will be huge in retirement. The RRSP takes center stage in those years where you are in higher income brackets so that you can defer taxes at the higher rates. For example, if you had a year where you were in a much higher tax bracket, it does make a lot of sense to put that higher taxed money into your RRSP so you can eventually use it later at a lower tax rate, thus saving on taxes overall. Now, if you have room in your TFSA and you are experiencing a lower income year, it does make sense to pull some income out of your RRSP and then move it into your TFSA, provided you do not need it to meet, well, basic needs, things like that. It can get expensive out there these days. Getting that TFSA filled is a very good goal. In fact, even pushing yourself into the first tier and paying 15% tax is not a bad decision, especially if things are looking really good financially within your retirement. One example aimed a little bit at lower income Canadians is if you had a year where you only made $5,000, that means that you could actually pull $10,705 out of your RRSP 100% tax-free. So whatever taxes you were supposed to have paid when you deposited that money into your RRSP, those are absolutely gone in that situation. After that, you are in the next tier, and it is going to cost you 15% in taxes to take more money. This is where math really becomes your friend. You can play the tiers to ensure that you are paying lower taxes or no taxes on those very low income years, keeping an eye on the future and the incoming retirement years, and of course the size of your RRSP will absolutely be a factor in your overall math. You do want to keep in mind that whatever you do pull out of your RRSP, your broker will charge a withholding tax on it. Usually it is between 10 and 30% depending on province and the amount withdrawn, and that gets sent directly to the CRA. So in this case where you will owe no taxes, you're going to get that back at tax times. You do of course have the option once you are 55 or older to turn your RRSP into a RRIF. This will allow you to pull out the automatic scheduled amount without paying withholding taxes on it, though you will pay withholding taxes on any amount above that. As you look to retirement, you want to start thinking about how much income you will have, because getting an idea of that helps you decide if it makes sense to pull out of your RRSP before you retire. Keep in mind, the very low income years are, well, those ones are no-brainers. You should be pulling out and putting into your TFSA if you've got new contribution room. Some data you may want to know for your calculations include, well, your old age security or OAS. So in 2024, it worked out as $1,057.01 per month, or $12,684.12 per year. That, of course, is taxable, and it will begin to get clawed back if you make more than $90,997. Keeping that in mind, you more than likely do not want to exceed that amount with your meltdown strategy. Also, you can delay taking OAS and get a bonus of up to 36% if you delay it until age 70. If you get GIS, that is not taxable. If you are single, you can get a maximum amount of up to $1,065.47 per month. GIS will not usually come up in a meltdown strategy, only because most people using that strategy are making more than the limit to get onto the GIS. Now, the CPP can vary as it is highly dependent on how much you contributed. You can get a ballpark amount by logging into Service Canada. They have a tool for that. With CPP, you have a choice. You can take it early for a reduced amount of 0.6% per month down to a total of 36% reduction at age 60. Likewise, you can take it late for a maximum increase of 42% at age 70. That works out to 0.7% a month. When you are looking at your meltdown strategy, you also want to think about your life expectancy. If you are ill and you really do not expect to live a long time into retirement, then you may want to be a little more aggressive with the meltdown. Conversely, if you are very healthy and a lot of people in your family make it beyond 80, you may want to be less aggressive as you have more time to shake out the cash. We will do this using an example. We have a single man named John Q. Banana, and he is pretty healthy and expects to live to 85. So we will start with his income and investment accounts. He will get $12,684.12 in OAS. That's taxable. He is expecting $12,281 in CPP. Once again, that's also taxable. He is making too much for the GIS. He has done well with his TFSA and has $112,000 in it. And for simplicity, he has a fully income-producing portfolio and is receiving an 11% dividend. So his TFSA is basically giving him $12,320 per year, completely tax-free. He has a total of $24,965.12 taxable income and $12,320 tax-free income. So he's basically getting $37,285.12 a year. The rest of his income is going to come out of that RRSP. John has a pretty good RRSP of $675,000. we could just look at the fact he expects to live for another 20 years and split it up to $33,750 per year. That does seem logical, other than that 85 estimate can be wrong. And I like to always err on the conservative side. So if you add 5 years, that would make a $26,000 withdrawal each year and keep you flush with RRSP cash until 80 or perhaps a little bit longer, as the amount in your RRSP will still be growing. In fact, if he wants, he could also take off some of that growth, but I usually suggest leaving it alone just in case you run into a bear market before your time is done. This gives John $63,285 per year. One thing to keep in mind is that he is still getting new contribution space. So even if he can only afford, let's say, $5,000 to add to his TFSA each year and turn that into more tax-free income, he can be adding another $550 a year to that tax-free money coming out. He is paying taxes on some of that income, as he has $50,320 in taxable income, which amounts to roughly $7,107.31 each year in taxes. Okay, we're supposed to be saving taxes, so here is where the big tax savings come in. If I am right and he dies at 90, he will have paid $177,682.75 in taxes. So if instead he didn't burn it down and he was leaning more on his TFSA than his RRSP, and he still had about $500,000 left when he dies, well, he would be paying over $225,000 on that amount, in addition to some income tax yearly that would have another maybe $1,725 to the CRA's coffers. In this example, John Q. Banana saved $49,042.25 in taxes. So that's nearly $50,000 in your pocket and not the CRA's. That's the power of this strategy. The strategy itself, it's really simple. Just follow the math and play with the numbers. Calculate the taxes with each possible scenario. What do they look like if you take OAS and CPP at 65, at 70, maybe CPP at 60? Run the numbers and look for those lower overall tax opportunities. Maybe it makes sense to delay OAS and CPP and pull out more of your RRSP initially and then less towards the later years. You won't know until you run those numbers. Lastly, be sure to utilize your TFSA. In our example, we used it as a passive income generator. You may have a different strategy. Perhaps it is a total return TFSA, and you are looking at removing a percentage of it each year to cover the tax-free income part. There are no wrong ways. As long as the math works, do the math. It's not going to lead you wrong. Let's continue that learning journey by checking out this video on what happens to your stocks when we pass. Thank you for watching, and I will see you in the next video.